The financial world is in shock as reports surface that Ripple's on-demand liquidity network has quietly expanded to a staggering $500 billion, sparking unprecedented turmoil in the traditional banking sector. At the center of the storm, JPMorgan Chase CEO Jamie Dimon is reportedly in a state of panic as the implications of this liquidity surge become clear. For decades, banks like JPMorgan have dominated cross-border payments through correspondent banking systems, controlling trillions in reserves while charging fees that fueled massive profit margins. But now, XRP, once dismissed as a speculative cryptocurrency, is effectively draining these reserves, quietly siphoning liquidity from the old system while providing unmatched efficiency and speed to its users. Industry insiders suggest that the $500 billion milestone represents a point of no return. Banks that refuse to integrate with Ripple risk being sidelined, losing both market share and the ability to compete in global settlement networks. The drama is palpable, with the narrative framing not merely adoption, but the very survival of the old banking model hanging in the balance. As the numbers circulate, the scale of the liquidity pool becomes almost unimaginable. $500 billion flowing through ODL is not just a financial statistic, it's a tectonic shift in market dynamics. Traditional banks, once secure in their dominance over cross-border transactions, now face a reality where their reserves are being indirectly consumed by a decentralized blockchain-powered system. Reports from anonymous insiders describe boardroom meetings at major banks devolving into crisis mode, with executives scrambling to understand how to counter the XRP drain. The panic is not over adoption, it is over obsolescence. Unlike prior financial innovations, XRP does not wait for permission, consensus, or gradual integration. It operates at the speed of digital finance, moving liquidity instantaneously across borders, bypassing the slow, cumbersome mechanisms of legacy banking entirely. The very existence of such a vast pool demonstrates the growing asymmetry between old-world finance and the new era of programmable money. Investors and market watchers are reacting to this narrative with a mixture of awe and urgency. The $500 billion ODL figure is being dissected in financial reports, social media discussions, and trading forums worldwide. Analysts emphasize that this is not speculative hype. Ripple's network has been quietly gaining traction for years, and the numbers now reported suggest that the largest multinational corporations, fintechs, and even some central bank-adjacent entities are already leveraging XRP for global settlement. Each dollar flowing through ODL is capital once trapped in legacy systems, now liberated by blockchain efficiency. This creates a cascading effect. As banks notice liquidity leaving their traditional accounts, pressure mounts to either integrate XRP into their operations or risk falling behind competitors who can transact instantly at dramatically lower costs and without the friction of correspondent banking. The panic at JPMorgan is, well, pretty symbolic, a real harbinger of systemic disruption. From the perspective of the old banking hierarchy, the psychological shock is, honestly, pretty profound. For decades, executives relied on control over payment rails, interbank credit, and settlement mechanisms as, pillars of influence. XRP's ODL network challenges each of these pillars, and it does so simultaneously. Jamie Dimon, who's often vocal about his skepticism of cryptocurrencies, now reportedly faces an internal reckoning as the system he presided over shows cracks in real time. The liquidity drain is not just theoretical, it's observable, measurable, and yeah, it's growing. Banks must confront a new paradigm in which speed, efficiency, and programmable liquidity are, well, absolutely paramount. As Ripple's network expands, traditional institutions are really forced to reconsider not only how they operate, but whether their entire legacy model can even survive in a world that's increasingly dominated by digital native settlement solutions. The narrative is further amplified by anecdotal reports of major transactions moving exclusively through XRP. Multinational corporations seeking to avoid the fees and delays of correspondent banking are now reportedly routing hundreds of millions and sometimes even billions through Ripple's ODL system. Each successful transaction reinforces the utility of the network, attracting additional participants and expanding the liquidity pool even further. Market commentators point out the snowball effect. The larger the pool grows, the more banks are pretty much forced to rely on it indirectly, creating a cycle that just accelerates the marginalization of legacy systems. $500 billion figure becomes both a symbolic and functional threshold, a demonstration of network dominance that honestly traditional banks just can't afford to ignore. What was once dismissed as media sensationalism is now, more and more, being understood as the rational response to a financial paradigm that's shifting right under their feet. Meanwhile, Ripple's strategic positioning becomes, well, a lot clearer. The network's design allows for instantaneous settlement across multiple corridors, which means there's no need for a bunch of intermediary banks, and as a result, operational costs drop dramatically. The narrative of panic is, really amplified by media outlets emphasizing the human element, senior executives grappling with a loss of control, internal memos highlighting liquidity gaps, and these frantic strategy sessions all aimed at somehow halting the outflow. For the broader market, these stories frame XRP not just as a speculative token, but really as an existential threat to entrenched financial institutions, one that's actually capable of redistributing global liquidity in real time. Global financial commentators, they underscore the unprecedented nature of the situation. The $500 billion ODL pool represents a liquidity force that's larger than many national banking systems, effectively forcing the market to confront a reality where blockchain settlement is no longer optional. Cross-border payments, which were once seen as incremental and bureaucratic, now operate in real time with a level of transparency, security, and efficiency that the traditional system just cannot match. The panic narrative gains further credence when insiders note that some banks are reportedly accelerating internal adoption of XRP, not voluntarily, but out of necessity to maintain operational parity with competitors and avoid systemic exclusion. The death of correspondent banking is no longer just a theoretical discussion, it's unfolding before the world, with JPMorgan's high-profile response really serving as the emblem of an old system under siege. Investor sentiment is electrified as well. Retail and institutional participants alike are interpreting the $500 billion liquidity pool as a signal of both safety and momentum. Unlike other cryptocurrencies, XRP's utility is grounded in real financial flows. It is not merely traded for speculative gain, but actively used to move massive sums of money across borders. The scale of the pool also opens the door for broader adoption by financial service providers, fintechs, and multinational corporations seeking reliable, rapid liquidity. Analysts argue that each increase in the ODL pool further validates the narrative that XRP is not just another digital asset, but a structural innovation capable of reconfiguring the foundations of global banking. The psychology of scarcity and network dominance converges, creating a potent driver for adoption and market valuation. The implications here, really extend beyond just corporate finance and move into the regulatory sphere. Governments and central banks are reportedly evaluating how to respond to a liquidity network that operates, while independently of traditional correspondent channels. While some observers suggest that regulatory hurdles could slow adoption, others see the momentum of a $500 billion pool as honestly, politically, and economically irresistible. The narrative of JPMorgan's panic in particular is leveraged as evidence that even the most powerful banking institutions just can't resist the systemic pull of XRP's network. This framing positions Ripple not merely as a technology provider, but as a market disruptor that's, really rewriting the rules of global liquidity. Each new day of transactions through ODL further amplifies the story. Every settlement demonstrates pretty clearly the inefficiency of the old system, the speed of the new network, and the growing confidence of participants. JPMorgan's panic, amplified by media and analyst commentary, becomes a self-reinforcing storyline. The more liquidity drains from traditional accounts, the greater the incentive for banks to integrate with XRP, and honestly, the more critical the network becomes to global commerce. The narrative paints a dramatic picture, a $500 billion liquidity pool, operating silently yet decisively, reshaping the landscape of financial power, and rendering legacy banking practices increasingly obsolete. In sum, the $500 billion OD